reduce the counterparty credit risk. And we said in case of a typical OTC derivatives transaction which can occur between A and B, if B is going to default, then A is exposed more and more to the counterparty credit risk. So to prevent or to protect himself against that counterparty credit risk, A may ask for a collateral from B. That's a typical mechanism. And at the same time, even B may ask for a collateral from A. Now, the typical scenario is we will try to find out, both the parties will try to evaluate the mark to market value of their positions on a regular basis. And so at any point in time, you will see one party will have a positive M2M value, the other party will have a negative M2M value at any point in time. So whosoever is having positive M2M value, that particular party is exposed to counterparty risk. So to protect itself against that counterparty risk, the party whichever is having a positive mark to market value may ask for a collateral from the other party. So typically the collateral is an asset which is supporting a risk in some kind of legally enforceable kind of a mechanism. And generally in these kind of transactions, collateral is more of a bilateral kind of a contract. Whichever party is having a positive value, it will demand the collateral from the party which is having a negative value. And because of this collateral, probably there are some advantages that are going to crop up. Now overall credit exposure is down. Overall the credit exposure is down. And because there is some kind of a protection that is coming up, so probably for A which has demanded a collateral from B, some kind of risk is mitigated, because even if B default, there is some amount that can come out from the collateral. So overall the credit exposure will go down. And at the same time, now probably if the collateral was not there, A would have found difficult to initiate trades with B. But because B has posted a collateral, probably trading with the counterparty creates more, it gives some kind of a confidence to trade with that counterparty. And because the risk has gone down, even from regulatory capital requirements perspective, because the overall risk is lesser, the regulatory capital requirements also will go down, and the counterparty risk, whatever is there, can be priced more and more competitively. Because once I am giving a collateral, the risk is going down, so the competitive pricing also can come out quite comfortably. Now, all these things regarding how the collateral needs to be managed, what has to go as a part of the collateral and all, they go in as a part of a document called Credit Support Annexure. Credit Support Annexure. This is something that has been incorporated into an ISDA master agreement, which contains a lot of things. Probably the CSA talks about a lot of things, which is more like a legal, from a legal perspective, with an intention to mitigate the credit risk. The CSA is typically talking about, okay, what is the eligibility of the collateral, right? How much is the real worth, some kind of valuation issues, or how the interest will be paid on the collateral, right? What is it, a fixed rate, or is there some kind of a floating, or what is the substitutability clause? I'll talk about these things, but what is the substitutability? Can this particular collateral be replaced by something else? And probably are there any kind of haircuts applied to this collateral? So, and probably the reuse of the collateral, all these things, there is a kind of a proper documentation for all these things associated with the collateral. How is the collateral transferred?